The outlook is right. And who better than Gautam Baid, equity advisor at Complete Circle Stellar Wealth, is now with us on the show. Gautam, thank you very much for joining in. Things have already gone quiet. Typically, this action happens in the last 10 days of December, but we've been sideways now for the last few days. Take us through how you are seeing the market mood right now, the sentiment from investors, and what is the outlook over the next 3 to 6 months?
Hi Reema, hi Vivek. Thank you for having me on your show. You're absolutely right. It has been very quiet of late. However, global volatility is expected to pick up significantly over the next few weeks, primarily driven by a confluence of events. Firstly, the upcoming trade war, which Donald Trump will engage with the rest of the world after he assumes charge of the Oval Office on January 20th. Secondly, we will have a ripple effect on currencies across the world, particularly among Asian currencies, because China is expected to devalue its currency to remain competitive in the export market. And as a result, many other Asian countries, including India, may follow suit. And that may lead to further pressure from the FI selling, because currency depreciation is a key risk factor when it comes to FI. So that is one key risk to be on the lookout for. The second big risk is the ongoing economic slowdown, because of which the earnings growth in the Indian market has become very narrow. And as a result, this is the time to be a bottom-up stock picker and to focus on those stocks with sectoral tailwinds and earnings growth visibility, because government capex has been very subdued in the first half of this financial year due to the national elections and heavy monsoons in various parts of the country. Hopefully, in the next 6 months, driven by the thumping victory in the Maharashtra elections, the government will be emboldened to focus more on the development agenda and earnings growth will pick up steam. But this is definitely a time to exercise caution. This year, just like last year, has been very good for the markets. And generally, back-to-back strong years are followed by a year or two of very high volatility. So focus on the quality of your portfolio.
Okay, understood that, Gautam. Gautam, one space that's not really given too much exciting returns as far as investors are concerned has been the insurance space. But we believe you do like one particular company which could be seen as a proxy play in that space. So which is the company you like and your rationale for the same?
So just a standard disclaimer, we hold this stock in our PMS, a Complete Circle Stellar Wealth PMS. The name of the company is Medi Assist Healthcare, and this is a structural long-term play on rising healthcare insurance penetration in the country. The company is India's largest third-party health benefits administrator with a 30.4% market share in group health insurance premiums in FY24 and a 5.5% market share in retail health insurance premiums in FY24. Now, health insurance is a structurally attractive industry because of three key reasons: significant underpenetration, rising awareness driven by increasing medical costs, and commitment by the insurance regulator to drive insurance for all. And increasing volumes will make the claims management process more complex going forward. As a result, reliance on third-party administrators will increase in order to bring in cost efficiencies and savings. And MediAssist is well positioned to capitalize on this opportunity, being an industry leader. It has an asset-light, tech-led, negative working capital business model without being exposed to any of the major risks which face health insurance companies, like underwriting risks. At the current levels, the stock is trading at a FY26 P multiple of 35 times, and we believe it should be a long-term compounder in investor portfolios. The key risk in this particular business is client concentration risk. The top 5 clients contributed almost 70% to the company's turnover in FY24. And if any one of them move their claims processing work in-house, that can adversely affect MediAssist's revenue growth. So that is one key risk to look out for.
Okay, important flashes coming in from the CEA, Anant Nageswaran, where he says that we're on track to achieve a GDP growth of 6.5% to 7% for FY24, which was penciled in the economic survey. This comes on the back of the shocker that we got in Q2, when the GDP growth for India dropped to a 7-quarter low of 5.4%. He goes on to say that just pure arithmetic, there is a possibility that the Q2 GDP number may be revised higher as more data comes in. There is a possibility the number could be higher. And this drop, the weak number that we had in Q2 was an account of religious, observances in the month of September. There was also unseasonal rain. So all that played into, that Q2 number of 5.4%. But the chief economic advisor says that 6.5% to 7% in terms of a full year growth estimate that they had set out at the beginning of the year is still very much doable. And he also, I think, talks a little bit about seeing some signs about, private or corporate capex, picking up. So that's, the key takeaways from the chief economic advisor. So Gautam, we spoke about Medi Assist. There is another company that you like, India Shelter Finance. Tell us a little bit more about it and why do you like it?
Well, Reema, secured lenders like India Shelter Finance are finding favor in the current market environment compared to their unsecured counterparts. There are certain important investment thesis pointers for India Shelter Finance. Firstly, the company has industry-leading AUM growth. The management has guided for 30 to 35% CAGR growth in its AUM over the next 4 to 5 years. Secondly, higher proportion of LAP, loan against property, which is 40% of the loan book, results in better spreads versus peers. And because India Shelter Finance has 70% of its loan book in fixed rate loans, it will benefit from net interest margin expansion when the RBI eventually starts cutting interest rates after a few months. And thirdly, this company has a very robust tech-led business model with the lowest turnaround time in the affordable housing finance industry. From onboarding to sanction, India Shelter Finance has a turnaround time of just 4 days. This compares with 7 days for Home First Finance and 9 days for Awas Financers. So that is one more differentiating aspect of this particular business. At the current levels, the stock is trading at a FY26 price to book of just 2 times, leaving ample scope for valuation re-rating. However, the key risk in this business are twofold. Number one, geographical concentration. Madhya Pradesh, Maharashtra, and Rajasthan contribute almost 60% to the loan book of the company. And even though the company is trying to diversify away from these 3 states, that is a key monitorable risk in this particular business. And secondly, the second risk in this business is intensifying competition in the LAP segment, because many home loan companies are diverting their focus to LAP because of yield pressures in conventional home loans. So do keep the lookout on these 2 risks for this particular business.
Got that, Gautam. Thank you so much for joining us, giving your take on the markets and also your top ideas that you have as part of your portfolio as well. Well, we now slip into a short break. Up next, we put the spotlight on Zaggle Prepaid and Gravita India.